Hi, and welcome to the next edition of the FINtastic Talks. Thank you for being here. It's always a pleasure to do these talks, and I wish I'm able to contribute to your wealth creation journey. And together, we are making money together, and creating a better corpus for the future. And that's what the whole purpose of this talk is. This talk is trending really well. We have now crossed 1.2 million views, and both the last talks crossed 100,000 views. So thank you for that. Thank you for recommending it. Thank you for watching it. Thank you for being here regularly. And I just wanted to say that look, we can see every comment that is posted. So you please, if you have any question, any thought, anything you want to be answered, please do write it in the comments on the various platforms that you're watching this talk on. And we should be able to see that, and we should be able to respond to your questions on that. The purpose of this talk is to help people in their wealth creation journey. Aim is to help you create a second income. Second income means that one day your investment should be that big that they should be able to fund a lifestyle equivalent to your current lifestyle. So, when you're able to get an income out of your second income that is equivalent to your current or the business income or even more, is when you have built up a truly, large and truly effective second income. And that is very much possible. It is just a matter of starting on it. Yes, if you're early in your journey, it will feel impossible. But when, as it's like a driving a car, initially it's so difficult, but when you keep driving it, one day it becomes almost like a something that you don't even pay any attention with your conscious brain. Same is that with investments and wealth creation. It's just a matter of starting it, doing the right things, following the right norms, and there is nothing that can stop you on your wealth creation journey. We are very excited to have Navin Agarwal with us. If you remember, Navin was on the first edition of the FINtastic Talk. He was the first speaker, and it's great to have him back. Naveen runs Motilal Oswal Asset Management, which has been one of the most favorite asset management for retail investors, and it's given a fantastic returns across the products. Their products have consistently beaten the benchmarks and have been very popular with investors. He himself personally is like a soothsayer of the market. Let me say some things that he told last time in when we did that talk. It was in the middle of the pandemic, and he had made this comment that the mid caps will outperform the large caps. And for Motilal Oswal, mid cap fund has been their highest performing funds and has given fantastic returns in the last 2 years. He also talked about a V-shaped recovery, and we have also all seen that V-shaped recovery happen, and at a faster rate than what is expected. So now there is a lot of other confusions around the markets, but still that recovery that he talked about, that we are likely to see a V-shaped recovery actually happen. So without further ado, let me invite Naveen Agarwal, who I like to call the soothsayer of the of the mutual fund industry. Although nobody can predict this market, and it's almost impossible to predict. So, welcome, Naveen. It's great to have you with us on the talk.
Thank you so much, Mr. Bajaj, for having me once again. I fondly remember the first time that we were doing this show. I remember was in the middle of the COVID pandemic, and little did we expect that things would come back to normalcy, so quickly. And that is why they always say that equities is always meant for the optimists, like fixed income may be meant for the pessimists, right? And so basically I think a lot of the things that you spoke about, which got discussed back then, turned out to be true. But I would say a lot of it is coincidence. I don't think I have the crystal ball. We only have the history to see and see. You may recollect I said history may not repeat itself, but it surely does rhyme. A Mark Twain quote, and turning out that it does, seem to be rhyming for sure.
That's absolutely correct. That the we are seeing rhythms and patterns in the market. So, Naveen, the way what we like to start with in this talk is a little bit about you, your family, your journey. How did you reach this place? I know you've talked about it in the past also. So, just tell us a little bit about your family and how did you end up reaching where you have reached today?
So I hail from a place which is actually quite popular called Pilani, Rajasthan, which is where Birla Institute of Technology and Sciences, BITS Pilani, is, and that's where Birlas came from. And so, when my father migrated to work for Birlas in Mumbai, for him, what Aditya Birla was doing back then was iconic. And because his son Kumar Mangalam Birla went to Sydenham College and was doing his CA course, he asked me to follow him because the big boss's son was doing that. So I did that actually. I went to the Sydenham College where my seniors included, Uday Kotak and Kumar Mangalam Birla. And I obviously quickly, decided on the CA degree. But coming from a middle class background, insecurity is something that always bothers you. So I actually decided to collect a whole bunch of degrees, including cost accounting, company secretary, and CFA over a period of time. But the environment in Sydenham is very infectious. Seeing the stock markets being so close to you, I actually got introduced to the stock market literally in my early years of college, and we had the access to some of the corporate databases and some of the global literature on the subject, and that became the foundation for my journey into the stock markets. And so after collecting these degrees, I joined the stock markets as an equity analyst, went on to head research, managed portfolios, and about 22 years back, in June of 2000, I joined Motilal Oswal. And we were a 1 crore profit company, Sanjiv, back then in the year 2000. And I'm happy to tell you that 22 years later, last year, we reported a profit of 1,200 crores after taxes. So we've grown 1,000x. And from being a mere broker back in the year 2000 when I joined, we now have asset management, private equity, wealth management, investment banking, home finance, and various other businesses. While we manage 50,000 crores in public markets, I'm really happy to tell you that we are the guys with the highest skin in the game, and our own money in our AMC has crossed 4,000 crores of investments, which is arguably greater than all other AMCs would have put in their respective products. So the journey has been, all throughout in equities. Our passion is equities, and as a firm, we've invested all of our capital in equities. And as an asset manager, also all we do is equities. We believe in the power of focus. We believe less is more, even less is even more. And we believe that if we do one thing right, then that allows us to become seriously big in that thing. So that's really my journey and the journey at Motilal Oswal also, Sanjeev.
So, Naveen, I think this has been the most clear cut introduction I have heard on this. This is a question where people find it very difficult to talk about their childhood, why they did what they did. But you are absolutely clear, Chris, when this, reminds me of your views on the stock markets. You're always very clear, Chris, absolutely sharp on your views. And I think your introduction was very, very similar. So, Naveen, now coming to the markets, what do you feel? Our last talk was in February 2021. So we are
Yes.
now talking almost 18 months after that. So what is
Yes.
your view on the market? Where do we stand? What is your view? Just basic before we get into deep dive questions.
Yes. So basically, let me just remind the viewers about what we spoke then and where we stand in that journey now, because really we are in the middle of that journey. To be very honest, so February 21, the last set of financial results that we had was for the year ending March 2020, right? And March 2020 corporate profit to GDP was at 2%. And we highlighted that history may not repeat itself, but it surely does rhyme. And this seems to us like what happened in 2002 to 2008. What did happen in 2002 to 8 was that a 2% corporate profit to GDP went up to 8% corporate profit to GDP. And as a result, because stocks are slaves of earnings, Nifty, which started its journey on 1st of Jan 2002 at 1100 points, went up all the way to 6300 points. So it was the most fabulous journey in the stock markets, where in a 6 year time period, markets went up by nearly six times. This time around, when we were speaking in 21 early, corporate profit to GDP was 2%. As I speak to you now, corporate profit to GDP has already doubled to 4%. I
Wow.
believe that we are only midway in that journey. Correct. So we believe that the corporate profit to GDP will easily scale up to 6% and then 7%, and God willing, maybe even above that. So that's the first point. The second point is that, like the markets, Nifty moved up from 1100 points to 6300 points the last time around. This time around, on 1st of Jan 2020, Nifty was at 12,000 points. And as I speak to you today, we are just above 17,000 points. So markets are up by about 1.4 times only. Compared to the journey of 2 to 8% corporate profit to GDP, we are already at 2 to 4, and the journey continues, right? Similarly, the stock market journey is actually in its very early stages, according to us. We are only up 1.4 times compared to, I don't know whether it'll be up 4 times, 5 times, 6 times, but I say that this is not even the first half of the movie. It is in the early stages of the movie of India. And what is unfolding ahead in terms of corporate profit story, in terms of the salience of India on the global landscape, really makes us extremely excited. The second framework, if you recollect, I had shared was that India touched the first trillion dollar GDP in the year 2007. Obviously, we got our independence in 1947. So it took us a good 60 years to achieve the first trillion dollar GDP. We are in 2022 now, 15 years later. We have achieved in these 15 years what took us 60 years to achieve. So we are at $3 trillion GDP. It is our belief that over the next 7 to 8 years, India will replicate what it achieved in the previous 75 years, meaning we can add another $3 trillion to GDP. This journey from $3 to $6 trillion is one of the most exciting in the history of other countries which have traveled this journey. For instance, when America traveled this journey, their markets compounded at 17% per annum in dollar terms. When China traveled this journey, their markets compounded at over 30% per annum during this time period. We believe that India has the potential to generate a 15%, 16%, 17% plus return at a market level. And if you pick the right manager, the right AMC, the right product, then you can potentially generate even superior performance. So really, we are at a very exciting point. Now, what happens is that, and I like to highlight this, that like birthdays are an annual affair, right? Stock market falls are an annual affair also. Since the beginning of Sensex in 1979, markets have either fallen by 10% in a year or 20% or sometimes even 40 to 50%. The only difference between birthday and market declines is that birthday is on a fixed day, market declines are not on a fixed day, but they are equally annually recurring like your birthday. My only request to all the viewers, Sanjeev, today is that while you celebrate your birthdays, you should equally much as an investor celebrate the falls in the market, because in the longer term, stock market has created enormous wealth. These dips allow you to buy cheaper for the longer term. So really, I think that this is equally much a celebration for an investor, like a birthday is a celebration, and we should make the most of it. Every time that there is a fall, that is an opportunity to really add to your exposure to the stock market. So that the concept that you highlighted earlier about second income being more important than the first income. In fact, I'm a strong believer that a human being can work 8 hours, maybe 10 hours, maybe 12 hours in a day, maybe 5 days a week, maybe 6 days a week, right? But your money can work 24 star 7, 365 days. That's the difference. And if you put it to good work, then there are fantastic entrepreneurs in which you can invest, and they will work hard to ensure that your money generates even greater income then you can generate yourself one day.
Yeah, I think it's very well said, Naveen. So the key takeaway from this is that as an investor, you're actually in a very powerful position, that you're investing in entrepreneurs who are, working much harder than you. And today, this is one of the most exciting features of the stock market for me, is that I'm able to invest in other entrepreneurs. I'm able to invest in their hard work, their rigor, their effort, their energy, and I'm able to make money from that. And that's a very exciting. People talk about this guy's got unfair advantage, this guy's got unfair or fair advantage. So whether the guy's got unfair advantage or fair advantage, today you can make money by investing in that guy. So there is no reason for you to crib that this guy has got a better opportunity than me, because you also have that opportunity of being able to make money on that. And also very exciting, I found that, when you talked about when other economies went from 3 trillion to 6 trillion, I mean, your people have been very conservative. They say, look, next 10 years, India can expect a 12% growth, where you have said that, India can expect a 17% growth also. So guys, this is, 12 and 17% may not sound too much of a difference, but it will makes a huge amount of difference in the returns because of the rule of 72, which by now all of you would be understanding is that 72 divided by the rate of interest is the period in which your money doubles. So here, we are talking about if you are able to earn 17%, 72 divided by 17 means that virtually 4 years something you are able to get your money to be doubling. And if you get 12%, then your money doubles in 6 years. So if you go by that, in 12 years, you are sitting on 4x. But if you get it here, you are sitting on 6x in 12 years at 17%. So it will be a substantial amount of difference. So it's very exciting. And also, I like the fact of the birthdays, that, every like every year there is a fall in the market and you should celebrate it like a birthday. But Naveen, then the question comes from people is that when do I book profits? So what most of us are doing is that whenever there is a fall, at least for me personally, I put in money, and I've been very good at doing that. But point is that I also don't. But I have a problem. I don't take out the money when the market is at its peak. So because I think, okay, if I take it out, it's too high. Where will I invest the money? So let it be. So how do you take out your money?
Yeah, so we believe that money is not made by buying and selling stocks or by buying and selling funds. They are made by sitting on funds. Now, let us talk about some of the richest people in the world. So, for instance, Buffett has never booked profits in Berkshire Hathaway, or the Walmart family has not booked profits in the Walmart stock, correct? Or Radhakishanji Damani, who owns the Indian DMart, maybe he had to book some profits because of the SEBI regulation to bring down his holding to 75%. But otherwise, he's never going to sell his shares. So why do you want to sell? I mean, I would suggest to the investors on this call that you should sell when you need the cash. Don't try to time the market. Don't try to buy high and sell low. There is a study that got recently published, and is something which is empirically proven also, that globally the investor return is lower than the investment return. So the investment return is what the index or the fund returns over the life of the fund. The investor return is what investors in that fund have earned over the life of the fund. And that is often lower because while the theory suggests that you should buy low and sell high, most investors end up buying high because of the euphoria and selling low because of the fear at that time. And so I would suggest that, really take the profit, take money out of the equities when you need it, rather than taking money out because you think the markets are high. I mean, who knows how high they will get? And, like the pendulum, swings on both the sides of undervaluation and overvaluation. Markets will keep yo-yoing between undervaluation and overvaluation. It is very difficult for anyone to really, be sure about where you are in that overall cycle.
Yeah. So, Naveen, also asking this question that look, if I was to look at a 10-year horizon, what kind of funds would you recommend to me and why?
So basically, we believe that a good mix of a multi-cap, flexi-cap type of a fund and some of the mid-cap funds, I think is a good mix. You can always spice it up with 5 to 10% allocation to international funds, like we have the S&P fund, the Nasdaq fund. You can add some exposure to those type of funds also, which will provide you certain international diversification. Currently, some of these funds are shut for subscription because of the forex situation. India's forex reserves have come down by $100 billion, because of the high commodity and energy prices. But over a longer term, having a mix of 5 to 10% international assets, 90-95% domestic assets, and within that a mix of large cap and mid cap, or multi cap and mid cap funds is what we would recommend. However, if you are not comfortable with the volatility that the market has to offer to you, then you may be better off with a balance advantage or a dynamic fund, which automatically rebalances between debt and equity depending upon how rich the valuations are, so that you don't have to take the timing call on the market. The fund manager, based on a scientific process, will reallocate your assets between fixed income and equity. So, I mean, you can decide depending on the risk appetite, because we strongly believe in the power of equities and the magic of compounding of equities. We have chosen, because of our risk appetite, to allocate fully to equities, but you can decide your asset allocation depending on your risk appetite after consulting your advisor.
I think very well said. It gives a very clear-cut roadmap to our viewers. That look, if you are confused, then go for balance advantage, or you're conservative, because there the fund manager is going to do the movement between debt to equity, equity to debt, and genuinely it's today balance advantage products, as I say to our investors, are the bread and butter. They are the what company fixed deposit or bank FD used to be in the past. Today balance advantage funds are there. If you have any money and you don't want to take a call on the market, put it in balance advantage. It is the most cleanest and the quickest opportunity. But when you are coming to a long term portfolio that you are creating, if you look at a 10-year horizon, then I think flexi cap is a good opportunity where the fund manager is taking those calls. Naveen, but there are people who are in the older age group, especially in the Bajaj Capital family. We have 4 lakh customers, and a lot of those customers are above 60 also. And today we are dealing with three generations in a family, where we are dealing with the grandfather, the son, and now the grandchild. All 3 generations are investing through us. So they are people who have got a slightly shorter time span, maybe a 1 year to a 2 year time span. Given the Russia-Ukraine war and the kind of inflation it is causing, what will be the impact? What do you think? How is the global economy? Is it something which is just going to be pass away and the economy is going to rebound, or is there pain out there? What is your view?
No, there's definitely pain out there with the dislocation in the energy prices, commodity prices, freight rates. Although we have started to see normalization of some of these variables, I think there are a lot of things out there which present risks. As you know, India's trade deficit and current account deficit has gone up because of the higher, commodity prices, and that has caused rupee to depreciate almost to 82, rupee to a dollar. Also, globally, money is being taken out of risk assets as the dollar is appreciating. And while we had a month of FI flows, we once again seen FI flows turning negative as far as India is concerned. Last year, we had a lot of money coming into startups, huge multi-billion-dollar checks being written in the chase for the startup ecosystem. That is increasingly drying up also, right? So there will be second order impact of this. We've already seen the US S&P 500, the Nasdaq correct quite meaningfully, while the Indian markets have not corrected as much. We believe that the Indian story will be decoupled from how the developed world or the US markets behave from a longer term perspective, where the Indian markets will continue to do well, notwithstanding the correction that they may see. However, having said that, from a near term or a short term perspective, there is always a possibility of a meaningful correction in the market given what has happened to the global market. So I would not rule that out right now from a stage of near zero interest rates and quantitative easing where balance sheets of central banks have gone up many fold. I think we are only at the very early stages of rate hikes and quantitative tightening, where liquidity is being withdrawn at the rate of $60 billion every week. And this is something that will test the liquidity of the markets, the patience of the markets. And really, we cannot be very sure about the second order impact that this may have on the overall markets. So I think, as I mentioned to you, like birthdays are an annual affair, corrections are an annual affair. That is something that can happen and has not maybe happened very meaningfully, and is something that one should be aware of. Usually, we don't take market timing calls, but because you asked me this question, I believe that there could be risks in the near term that could cause a correction in the markets.
Yeah. So guys, in this scenario, to summarize, balance advantage is a good opportunity if you're looking at a 1 year, 1.5, 2 year horizon. Naveen, my view currently is that given what is happening on the global markets and with the commodity prices and a lot of equations changing, in the short run, next 6 months to 1.5 years, maybe the blue chip or the larger companies will be stronger and they may outperform the smaller companies. What is your view? Is this, if with a 1.5, 2 years time horizon, is this the time to have more of your money in large cap stocks, or you feel that still there is opportunity in small and mid caps?
So actually, rather than generalizing in terms of the capitalization, we are a bottom-up investor, and if I find a fantastic opportunity in the mid-size space, then I would not wait for a market correction to buy it. I would buy it as soon as I can. And similarly, as far as large caps are concerned, not all the large caps will be safe. Those which are exposed to the global, trends may be more vulnerable compared to those who are exposed to the domestic trends. So I think we are more focused on certain businesses that we like, certain managements that we like. Our operating philosophy, as you know, Sanjeev, is QGLP, where the funnel starts with the quality of business, quality of management. The next level of the funnel is the growth in earnings. The third level of funnel is longevity of those quality as well as the growth attributes. And finally, buying at a reasonable price is extremely important. So that's the broad funnel that we use. And any company, whether it is in the large cap, mid cap, or small cap space, that fits that criteria is what will get added to our portfolios. Having said that, you're absolutely right when you say that large caps may be able to handle volatility better than the small and mid caps. We've also seen a lot of margin changes by the exchanges, by the regulator. And so, in that light, you may see greater volatility in the small and mid cap space, and large caps may be more resilient in the times of global volatility. So, I would totally agree with you on that.
Yeah. So, guys, the takeaway is that look, if you have a shorter term horizon, look at more focused or funds, the funds which are doing more stock based investing, or if you're going in for a more generic category, then you can look at a larger cap funds at least for the next 1 year. But you have to be conscious whenever the global scenario changes, then you need to build in a right allocation in a small and mid cap also, because your overall return is going to be coming from the right asset allocation, which is a very very important point of investment strategy. And it is always good to work with a good advisor. Here, let me market Bajaj Capital. I think we have done a great job in helping the maximum number of people reach crorepati through investments, and we wish we are able to do it for everyone who is watching the talk today. So, taking on some question, Naveen, this is a question which is being asked by a lot of economists. One of our, viewers, Pandi Ramanathan, is also asking this question. Rupee is not sliding, dollar is strengthening. Finance minister said this, and that's actually true. But why is the dollar strengthening? Because there is a huge pain in the US economy also. As Einstein made this, a statement that money never goes out of circulation; it moves from one pocket to another pocket. So even in US, all the money from US and Europe is moving into the US pockets of the oil companies and the arms and the ammunition companies. So, but still, how is the dollar strengthening? Because overall, the US economy is in a precarious situation. It is printing more and more money. It's not actually strengthening. Then why is dollar strengthening?
So actually, if you see, dollar is the reserve currency of the world. So whenever there's uncertainty in the world, whenever there's geopolitical issue, whenever there's a war, you will see money being taken out of risk assets, and you will see money rushing towards relatively safer havens, and that is what the dollar is being perceived as. Importantly, you may have seen rather meaningful hikes by the Fed rate repeatedly, in terms of the interest rates, and that in turn makes returns in USD attractive. So I think a combination of what is happening to the world at large, where dollar is the safe haven, and a combination of the rising interest rates that you've seen with potential to further increase interest rates there, is what is causing world to move away from the risk assets into the safe havens. And on the other hand, the rising interest rates is only making it more attractive to invest there, and that is why you are seeing most of the emerging market currencies really depreciating. In not only emerging market currencies, but uh, currencies across the board have actually depreciated a lot more, in fact, than INR compared to the USD.
So you think it's basically a game of interest rates, that people still prefer high interest rates in US rather than being taking a risk at this scenario in the global markets. That's the whole game.
Yeah, and it's a safe haven also, given what is happening globally.
So, Naveen, also another question that a lot of people in India are hearing about, there are a lot of questions around this, so I can't pick up one, but the basic concept is people are saying, look, Make in India is said to be the next big thing. And similar is the defense manufacturing, the manufacturing. So, if we want to participate in this sector through our mutual fund investments, which are the mutual funds we should pick, which are going after Make in India, which is going after Indian defense industry? How if they want to be a part of that, they want to allocate a part of their capital to that. How what type of funds enable them to do that?
Yeah, so basically, there are a whole variety of themes that will benefit out of the China plus one strategy. China was a factory for the world, and everybody had kind of given up their manufacturing in favor of China over the last several decades, only to realize that being fully reliant on China for all your supplies is not such a good idea. And India itself is realizing that, and that's why we've launched what is called the production linked incentives here. We've got Make in India as a big focus area, and so while India is looking to increasingly reduce its dependence on China and start making in India, the world also is increasingly dependent on India to offer a supply chain as an alternative to China. And we believe that the beneficiary of this could be a variety of sectors. You could have chemicals that are being produced in India, then being produced in China. You could have defense equipment being produced in India and even being exported to some of the other countries, but definitely greater indigenization there. You could have electronics. You are already aware of the Apple factory that has got set up, and more, TVs, refrigerators, washing machines, dishwashers, everything is getting produced in India. We believe that funds which have exposure to some of these sectors could be a beneficiary out of this whole Make in India, mega theme. but this is something that will take time to play out. As you know, that there are only a handful of companies like Dixon, Umber, which are into electronic manufacturing. There are a whole bunch of chemical companies now that are available. There are quite a few defense companies that are listed, but manufacturing as a proportion of GDP has only contracted over the last several decades, and to bring this back, up is a slow and a gradual process. And so, I would say a diversified fund will always be a better option than trying to play it thematically through a narrow fund, because sometimes execution may take time, which may cause disenchantment with some of these themes. So one can be a little more gradual. One could rather approach it through a diversified fund and let them reallocate more and more towards these sectors as you have evidence available of profitable growth that is possible from them.
Yeah, Naveen, but it's a good idea also. Maybe there is a need for a sectoral fund called China Plus One.
Yeah, absolutely. And our passive funds will definitely evaluate that idea.
So, also taking the next question that investors are asking, there's an investor called Samaprit Swain, and a lot of other investors also have been asking that recently there have been a lot of changes in SEBI rules, like to stop the pool accounts, two-step authentications. This is actually making the investors a bit nervous that was there something really going very, very badly wrong with the industry, or or they were in a very convenient place where you used to find things very convenient which have now become inconvenient. So it's making investors a bit concerned about mutual funds. This thing, what would you like to say that what's the intention or the reason, and what should the investors reaction to this?
There is always a short-term adverse impact of some of these things. But my own journey in the Indian capital markets, we've seen, from ring-based trading to screen-based trading. We've seen from BSE and other regional exchanges to a national stock exchange being created. We've seen, script paper trading to, paperless trading and demat accounts being set up. All that has laid the foundation for the number of investors going up from a few million to 100 million now, right? All of that has seen trading in the Indian stock markets being taken up from 50,000 crores maybe at one point in time to now on certain days the volumes are in excess of 300 lakh crores in a single day, right? So exponential growth in the market is only possible if there is robust risk management, right? And we believe that all these initiatives announced by the regulator uh, are only going to make our markets stronger and being able to withstand any potential correction or any big volatility in the global markets. So I think anything that imparts a lot of longevity, right, to the whole story of India, and doesn't become like a banana republic like any other emerging, some of the emerging markets become frontier markets. I think that is something that is in the longer term interest of the investors as well as the overall market. So I think despite these creating short term pressures on the business and the investors, we are actually in favor of a lot of these things that the regulator and SEBI is announcing, for the better health of the markets in the longer term.
So, Naveen, next question is from Radhika Gupta. She's asking this Diwali, what are the best sectors for investment to be picked up? Although Radhika, we have answered this question. It's basically don't try to pick up sectors. Go for a diversified fund. Let the fund manager do this job for you, or go for focused fund where they are picking up focused companies which are going to do well in this scenario. But since you have asked this question, we'll let Naveen answer it.
Yeah, so some of our favorite sectors are, domestic facing, I would say. Uh, the banking sector has gone through a lot of pain from very high NPLs. Now, most of the banks have cleaned up their balance sheets, particularly the private sector banks have cleaned up their balance sheets. You may have seen that the credit growth, which used to be in, mid single digit last year, has been picking up, and we've seen robust credit growth of almost 15%, partly because of the low base that has come up. Both retail lending as well as corporate lending are growing quite strongly. We believe that with the strong balance sheets of the corporate sector, with rising inflation, right, expected economic uptake, expected investment cycle, we expect credit growth to likely remain strong over the next 3 to 4 years. We expect asset quality cycle to be quite benign, over the coming years. And banks with very strong liability franchise, deposit franchise, CASA franchise, will be able to reap the most benefit in this cycle. So we believe that the robust, very strong banks, very strong NBFCs is one of the very interesting themes that should play out over the next few years' time. The second theme that we like is domestic consumption. So automotive sector, autos, Murphy's law was applicable there. Everything that could go wrong went wrong with them. Commodity prices went up, semiconductor shortages hurt production. People stopped replacing their vehicles because they were working from home, and all of this combined with higher energy prices led to postponement of new model launches by the auto companies. So all of these 5 6 variables are now turning for the better. Global commodity prices are coming down, semiconductor shortages are easing, new product launches have now begun, replacement cycle has started, and we believe that Indian auto penetration is still at a fraction of where it could be over the coming years, and hence well entrenched automotive companies is something that also look good. The other part of discretionary consumption, which includes retailing, which includes QSRs, which include all forms of consumption, discretionary consumption, is something that we also like. So we believe that domestic facing stories, from financials to discretionary consumption, have a very strong runway as India's GDP doubles from $3 trillion to $6 trillion. In fact, we believe that this linearity in India's GDP growth will present some very smart entrepreneurs who will have exponential growth during this time. So all you have to do is buy right and sit tight. You have to hold on to these, top class entrepreneurs, and sit on those businesses and allow the magic of compounding to play out. And I'm sure the returns of 15 16% that we're talking about for some of these companies could be even higher than that.
Okay, superb. So you came down to the philosophy: buy right and sit tight. But that's actually the core of the value investing. Also, there's a very interesting question which has come up, Naveen. People are saying, look, Indian markets are being driven by the Indian investors, and we have seen the foreign institutional investors move out in hordes. But Indian investors, their potential to save actually going down because of inflation. Because India is also seeing an unprecedented inflation in commodities, in petrol, and other things. And at the same time, the tax regime seems to be to keep on taxing the individual tax holders more and more. So the free money is going up, is reducing in the hands of the investors, and today they can't sustain the kind of investments they were making in the past. So Naveen, two questions here. One is that given what is happening, the inflation that is affecting India and the tax rates going up, do you think this is going to affect the markets in the long run, ability of Indian investors to invest? Second is that is there any possibility of the the individual taxes going down? Do you think there is any possibility there? Can, given the inflation impact, can investors expect some relief there?
Um, uh, I really doubt, with the current state of affairs, there are likely to be any tax swaps that one is likely to get. But let me give you a context of how much really we have invested in equities, right? And how much is the runway going forward. So the savings of the wealth of all Indians put together is roughly $11 trillion on a GDP of $3 trillion. So that's about, you can say, 850 lakh crores. Or that 850 lakh crores, the largest asset class, right, is the physical assets, right? The real estate, the first home that you own. Let's say that is half of that. The balance, the second biggest line item there is fixed income. That's almost 35%, you know. And then the third biggest line item is gold. The smallest line item in your wealth at 4.4% of your wealth is equities. So out of that 850 lakh crores, only 40 lakh crores is invested in equities. Compared to this 4.4% wealth allocated to equities, this number in America is 45%. So we believe that the runway for households to reallocate in favor of equities is still quite long. And we would not be surprised if this 1,000 crore SIP, which became 5,000, then 10,000, and now 13,000 crores a month, could go on to become 15,000, 20,000, and 25,000 crores of SIP month after month. And if you multiply this 13,000 crores currently that we are getting into 12, you're looking at a 1.5, 1.6 lakh crores kind of annual inflow in equity SIPs alone, leave alone pension funds, provident funds, which have also started investing, etc., etc. So we believe that the domestic economy, as it moves from $3 trillion to $6 trillion, the kind of savings pool that will be generated will be 10x in the next 25 years compared to the past 25 years. And the reallocation to equities will be an even bigger phenomena. So we believe that domestic will play a very, very important role in terms of the Indian equity markets. In fact, we may not have to depend on foreigners at all as far as the Indian equity markets are concerned in the future. You remember earlier, all the talk used to be what are FIs doing. I think now going forward, that all the talk will be what are the retail investors doing, and I think they will own more and more of equities given the performance of equities. Let me give you one more statistic, Sanjeev. Sensex was born on 1st of April 1979. If you had invested a crore rupees in Sensex back then and held on to that, including dividends, that 1 crore would become 800 crores. But if you had invested the same 1 crore in bank deposits, which is where most of the Indians have saved their money, that would be worth 43 crores. And if you had invested the same crore in gold, that'd be about 76 crores. So imagine what equities has done versus 40 crores in fixed income and 80 crores in gold. You made 800 crores in equities. This is something which most Indians now realize and are gradually reallocating more and more in favor of equities. So I believe that the power of domestic savings, the power of retail investor will only rise with every passing year. And I'm sure Bajaj Capital is doing a wonderful job in terms of channelizing those savings of the retail investors into the Indian markets.
Thank you for that, Naveen. We are always trying. Okay, so and Prachi has asked a similar question. I didn't understand the question fully, Prachi. Is that what is the new tax regime implementation on India in the investment scenario? Uh, this can have a lot of different meanings, because this can be the new corporate tax structure, the individual tax structure. So, Naveen, would you like to take this?
So I personally doubt if there'll be very meaningful changes in the tax structures in the forthcoming budget in February 2023. I really or end of Jan 2023. I really doubt if there'll be any meaningful changes. I think corporate tax rate at 25%, personal tax rates where high income categories go up to 43%. I think those are all. I think the government will want a relatively stable tax regime. So that is what I would expect, and I don't see any meaningful changes because of the uptick in the economic activity. The GST collections have been growing, and we expect them to continue to grow both because of compliance as well as economic buoyancy. Uh, so those are the things that should help. I think to some extent our own deficits may be calibrated once the global commodity prices come down a little bit, but we don't expect any major changes in the tax regime in the coming budget.
So Prachi has given a clarificatory question that she was talking about the individual tax regime. So Prachi, as an industry, let me assure you, Naveen, me, we will try to do as much campaigning to the ministry to reduce the individual tax rates. But as Naveen has said, the possibility seems remote, but there is no harm in trying. So I know there are a lot of people who have posted this question that the individual tax rate needs to go down to bring in more compliance to the taxations in the country. So we will definitely put in our two words, but at the end of the day, it's in the hand of the government. This is not something we can do anything about. So there's also a very interesting question by Priyanka. She's asking on her own this thing that her fund last 2 year has given an 8-9% IRR. Is this good or is it bad?
If it is in the last 2 years, then it is definitely not good because in the last 2 years the markets have done better. However, I talked about the investor return and the investment return. Many times when we take a call to buy the best performing fund of that time, we did a study that if you always bought the best performing fund from a trailing 3 years basis, there's a possibility you bought the worst performing fund of the next 3 years, because performance also has its own cycles, style has their own cycles. Consistently delivering best in class performance forever is an impossible trait, and even Warren Buffett has not been able to do that. So really, we believe in buy right, sit right. So if you really buy a fund and you sit through it over long periods of time, then there is a possibility that you will at least earn the market return or even better than the market return. So at least that is what we would advise, rather than trying to hop from one best performing fund to the next best performing fund.
Yeah, and I think Naveen has said something which is worth its weight in gold. Whichever fund was the best performing fund in the last 3 years, and that's how most of us as retail investors buy. We look at the past performance, we look at the rating. Oh, this fund has been the best performance for the last 3 years. But empirical evidence has shown that 99% of the times, a fund which was the best performer in the last 3 years doesn't remain the best performer in the next 3 years, because it is about the calls that the investor has taken. And this is where the value of Bajaj Capital, the research which helps predict that in the next 3 years these funds are likely to do better, and why. That's where we add our 1 or 2% alpha, and that is why you go through advisors. That if you're on your direct portfolio, if you are getting 12-13% through Bajaj Capital, if he can help you get 15-16% by helping you select slightly better funds. Because at the end of the day, there's no major difference if you're in the, at least unless you're taking very wrong choices like sectoral or very weak funds where where the advisor is selling it to you only for high commissions. But if you are in the good fund category, there is a small difference, but that small difference can make a huge difference in the long run. Also, there are a lot of these questions about working for Bajaj Capital and Motilal Oswal. Let me tell you guys, we are always looking at people. So you can always apply to Motilal, I'm sure, on their website, and on LinkedIn they have a place where you can apply. Same is with Bajaj Capital. You can go to the Bajaj Capital website and apply there. Also, I would like to tell you, for freshers or the people who are not from this industry, we have created a program called International Diploma in Wealth Management, which is a 3-month program, and then you do a 3-month internship. You pay a very minimal price, but you get it back. So we guarantee you a placement between 4.5 lakh to 6 lakh rupees starting. Plus, you grow faster because you have done your CFP, all the regulatory certifications you require to work in the market. And this is a fantastic way to start a great career in wealth management. Because see, please understand, people want to join, but they don't have the necessary knowledge or the certifications to work in this market. Like Naveen himself gave his story that he got his CFA, he got his other certifications. That is why he was able to excel in the market. So it's not about getting a job, but it is about winning in your job, which is very important. And I would like, since there are so many people who have posted for a job, team, please, if you can place the QR code for the IDWM course, where whoever is interested in working with us, or even Motilal, please do the program. It will help you get all the certifications, and you will do better in this market than you would do on your own. So we are almost at the end of the time. Naveen, some last things that you would like to say to our viewers and investors, something that they should keep in mind, or what would be your takeaway for them?
So I would say that Sanjeev, we are all very, very lucky to be in this beautiful country called India at a time when the transition from $3 to $6 trillion GDP is happening. We believe that this is a time period where extraordinary wealth has to be created in equities. We have a lot of entrepreneurship in India, and the diversity that the Indian corporate sector offers is something that continues to excite me after being in the markets for over 30 years. And so, my advice to investors would be that over the next 8 years, please do buy right and sit tight with your investments. Whether you buy a Motilal Oswal mutual fund or any other mutual fund, just stick with it for the longer term. And I think the kind of wealth that can be created in the coming years is something that could surprise all of you. Celebrate dips in the market like you celebrate your birthdays. Don't be scared, don't be afraid, don't run away from that, and try and gradually increase your equity allocation. Really, I don't know of any person who's become world's richest by investing in fixed income. All of the world's richest investors are basically single stock holders. Whether it is the Walmart family, or whether it is Warren Buffett, or whether it is Jeff Bezos. We don't have to own a single stock. We can own funds which will bet on some of the best entrepreneurs. And at a time when the belt below, in terms of the economic growth itself, is going to be strong, in terms of the corporate profits is going to be strong, stocks are really slaves of earnings. So we believe that the most exciting phase of wealth creation is really ahead for all of us. So please make the most of it, buy right, and sit tight.
I think that's very well said. So, guys, till you don't run in the race, you don't win. You can't win the race. So, the most important thing, Naina has asked this question: what are the prerequisites of successful equity investing? Naina, prerequisite is start running the race, start investing, stop waiting. There are so many people I meet. I want to start myself. I want to invest in the market, but I'm waiting for the right time. There's never a right time. The right time to invest is today. Start on your journey, and you will win, provided you buy right and you sit tight, and get a good advisor to work with you on this journey, because today his interest and your interest are absolutely aligned. So he will make money only when your portfolio increases and you remain with him. So point is that yes, today we are in a much better scenario than earlier, where you can actually get quality advice. But guys, the best way to start creating wealth is starting to invest. Okay, so a lot of people are not investing, and then they feel, why am I not creating wealth? So if till you don't take that risk, you're not going to get that return. So, guys, to start investing, take that risk. And thank you, Naveen, for having you with us. And, it's always a pleasure to have you with us. And I'm sure you gave us some very exciting takeaway for our viewers today. Thank you for being with us again. And bye, everyone. Thank you for joining us today.
Thank you for having me. Thank you all.
Thanks. Bye.